Andy, you're being very kind. Thank you for your very kind words, and it's very much my pleasure to be back with you again. And going back to what Shane was saying in the introduction about sort of hitting the button. One of the things that I really am so keen on is to educate people about what actually is going on, not the official version, but the real version. And I and also a number of my colleagues, like James Turk, have dedicated ourselves to that end. And I think it is desperately important that people do understand what's going on, because it's getting more and more urgent that they protect what they have from what might happen.
Yeah, obviously, we're always looking forward to getting your views on some of the economic drivers relating to gold, etc., because we obviously all focus on gold. But what perhaps we should start by looking at the elephant in the room, which is, of course, the petro ruble, the blowbacks of the Russian centric sanctions are having on the West. And I know you've done some excellent work, read it on Zero Hedge a couple of times, 2 or 3 times now, recently been published a lot, because I think people look to you now for, you've included the history and how this all comes together. But what's your thoughts? Again, you mentioned the narrative. You question the narrative. We all question the narrative, and that's an important thing.
Yeah, I mean, my approach to this is very much sort of top down. I mean, from the very, very far top looking down. And if you look at the geopolitical dimension to all this, what we are seeing is we're seeing the emergence of superstates in Asia. And these superstates in Asia actually have a pretty good understanding of what the Americans are doing with their money. And I mean, we first noticed this back in March 2020, when the Fed went all in with zero interest rates, 120 billion a month of QE. I mean, it was clear to the Chinese that this was the most inflationary move they'd ever seen coming out of the dollar. So what do? They started stockpiling commodities. I mean, we're not just talking about copper, nickel, the dreaded nickel, but also grains. And so we've got a situation where even before Russia walked into the Ukraine or tried to take out Ukraine, China had the majority of the world's rice stocks, wheat stocks, maize stocks, I think about 30% of global soybean stocks. So, when this is for 20% of the world's population, now, very, very smart move, particularly with the benefit of hindsight. Now, whether they knew that the Russians were going to attack Ukraine or not, we don't know. But the effect of that is that this summer, there is going to be genuine starvation around the world. And the Chinese were protecting themselves from this. So, China has already commoditized her currency in that sense, and you can see if you look at what the Chinese renminbi has done against the dollar since that March episode for the Fed. The renminbi has increased by, I think, around about 12% or so, or thereabouts. So there has been some protection there, not total. And China still has firepower to protect her own currency, which she has not yet deployed. And by that, I mean undeclared stocks of physical gold, which she does not include in her reserves. And I estimated that could be as much as 20,000 tons back in 2002. And that was when the Chinese government then permitted the Chinese public, to begin to accumulate gold. They opened the Shanghai Gold Exchange, and they even advertised on television, buy gold. And the result is that since then, roughly, I think just over 20,000 tons of physical gold has been withdrawn, in other words, delivered from the Shanghai Gold Exchange. So, we can see that I would say a minimum of 20,000 tons is in Chinese government hands in various sources. And also, you've got another 20,000 tons in public sources. Now, the public holding is probably 60 to 70% jewelry. So it's not monetary gold quite in that sense. But in Asia, as we all know, the Indians and the Chinese do regard gold jewelry as money, and there is very little premium, if you like, between jewelry and physical gold, and they use it. I mean, in India and Indonesia, there are networks of pawn shops who will take in gold as collateral for loans of paper money. So what you get in India is you get the farmers literally, when it comes to sowing next year's crop, they need to buy the seed. How do they do that? They go along to a pawn shop with their wives' gold bangles and they deposit them and they get rupees back and they rush out and buy the seed. And at the end of the season, they can redeem it all back. That's the way it's worked for a very, very long time. And indeed in China, the word for money is the same word for gold. So, there you have it. This is a very different world from the one we have had from 1971 when Nixon ended or suspended temporarily, I think the word was, the Bretton Woods Agreement. So then we come to the situation over sanctions against Russia. Well, the first thing that happened was that when Russia walked into Ukraine, supplies from Europe's breadbasket to the rest of the world are basically compromised. And not only that, but that area is a huge producer of energy-intensive fertilizer, which the rest of us rely on to greater or lesser degree for the production of our crop yields. So you can see, going back to what I was saying earlier, that we are genuinely heading for starvation in parts of the world, and I mean not only in the LDCs, but also in major economies such as ours. I mean, the poor in this country, in Britain, are going to have a hell of a hard time in the summer feeding themselves and their families, between that and energy prices and all the rest of it. So that's not good. And then we had the sanctions. So the price rises which are being brought about by the sanctions haven't even hit yet. And I saw this morning that Germany's producer prices are up 30%. That's, this is in the pipeline now. And then there was the third bit, which I found interesting, and I'm still sort of digesting it really, and I'm writing about it for tomorrow's article for Gold Money, and that is that the sort of, if you like, the Central Asian bloc of ex-Soviet states, plus Russia, plus China, are planning a currency to replace the dollar for cross-border settlement. Now, I think that will probably extend beyond that into the whole of the Shanghai Cooperation Organization, which encompasses, including India, Pakistan, Iran, China, and all the rest of it, all these very, very big populations. 40% of the world's population are in the SCO. Now, the one thing that they don't want is they understand that when the dollar's purchasing power goes down, because it is being debauched through issuance by the Fed, that there is a transfer of wealth from dollar deposits to the US government. Now, if you're a trader in the middle of Asia and you got a dollar balance and you see this going on, you say, hold on a minute, we don't want this. So this is, if you like, the driving force behind this new currency. The new currency, I mean, it's details yet to be properly released, but from what we can understand from the architects of this is that they plan to incorporate, first of all the national currencies in that bloc, in that Central Asian bloc, and also 20 odd commodities. Now, this is interesting because gold isn't mentioned. But I can see that from a purely strategic point of view, there would be a worry that if they say, right, we're just going to have we're going to introduce gold. I mean, remember that Sir Isaac Newton, back in 17, whatever it was, when he was master of the Royal Mint, reckoned that the currency, sterling, should be backed 40% by gold coin. 40%. It looks like they're doing a similar thing, not with gold, but wider commodities. So what's the difference? I mean, the difference is, from their point of view, that, if you've got one commodity, call it gold, that leaves your new currency open to being manipulated by outside forces. I mean, we see this all the time, and you can give us chapter and verse, Andy, on the interventions in the gold market, and how the various sort of, if you like, state interests and all the rest of it just whipsaw the whole thing around. Bank of International Settlements, the U.S. Treasury, whatever. So by having a basket of currencies, they are not exposed to that problem. I think that's the first thing. The second thing which we should note is that if you look at the purchasing power of the gold gram with respect to commodities generally, it's remarkably stable. I mean, it really is. The price of oil today in gold grams is 30% lower than it was in 1950. Now, it's a similar story with all the other commodities. The volatility is in paper currencies, not in commodities themselves when you price them in gold. So a basket of 20 commodities, okay, there's room for them to fiddle around with it and all the rest of it. We can accept that. But you can see that they're designing something which is getting away from the Western currency catastrophe. So what's the Western currency catastrophe? That's really the next subject. We're seeing prices rise out of control. And this is something which, for some reason, the central bankers either did not see or did not want to see. I mean, do you remember they were talking about transient and all this rubbish? I mean, we now have a situation where even on CPI measures, which actually don't capture the whole thing, you have got prices rising at over 8% in America. Now, if I go back to the last time we had an inflation episode, the 1970s, we went into the 1970s with the Fed funds rate at 6.6%. We're going into this one with the Fed funds rate at, it started off at zero. And if you look at at where we ended up in terms of bond yields, now this is the interesting thing. In terms of bond yields, the 10-year US Treasury note, I think, ended up yielding about 15% in 1980. And where are we now? We're less than 3%. Now, this tells me that there is a very substantial rise in bond yields and interest rates yet to come. I mean, there can be no other conclusion. So on that basis, we have a catastrophe. And we have a catastrophe because the whole of the post-Bretton Woods Western monetary system has evolved into a financially based system. Banks don't lend to businesses anymore. Big businesses, manufacturing. All the manufacturing has gone abroad. I mean, that's gone to China, Southeast Asia, wherever. What they're doing is they are just recycling financial assets. That is the collateral that the banks now have, the big banks. So what happens when they collapse? It takes out the commercial banks. It takes out the central banks, because guess what? They've become enormous hedge funds owning all this stuff through QE. And I mean, you can if you just look at what's happening to the Japanese yen at the moment, I mean, in the last from the beginning of March, it's lost roughly 12% of its value against the dollar, and the dollar's no angel either. So why? And the answer basically is they've got themselves stuck on negative to zero interest rates. And the Bank of Japan has actually publicly stated, we will not permit the yield on the 10-year JGB to rise above 0.25%. Come on. We're talking about an era of massive inflation. So what are they doing? It's quite simple. They're destroying their currency. The ECB has the same problem. The ECB's balance sheet is already in negative equity if you look at it properly. Now, who are their shareholders? Whoops, all the national central banks. What's their position? They're all in negative equity as well. And if you look at the Eurosystem's big banks, the global systemically important banks, they're pretty much all on asset to equity ratios of over 20 times. And in one case, as a French bank, I think it was Crédit Agricole, we're looking at 30 times. This is lunacy. I mean, conventional banking wisdom is that you could probably afford to have an asset to equity ratio of no more than 10 times. Yet here we are, 20 plus times. The Japanese banking system is also 20 plus times. So you can see that, if you're, the economist working for the Russian government, advising on the construction of a new currency, you can see, oh my God, it's actually very urgent. We get this thing up and running because we've got to escape this catastrophe, which is hitting the West. And that's roughly where we are. And the move to the unfriendlies, that they've got to pay for their energy in rubles, is completely consistent with the commoditization of the ruble. And what this means is that the ruble is going better against the dollar. I mean, I last saw it this morning, I think, at 78 to the dollar, having been 150 to the dollar. The high. For those inexperienced or who don't, sort of follow currency markets, if you have a high number of rubles, it's a weak ruble. It's actually come down from 150 down to a little below 80. And I would expect, I think it's going to be one of the stronger currencies. But the problem we have is that none of us in this call are likely to go out into the foreign exchanges and buy rubles or buy yuan or whatever. If we went to St. Petersburg to go and see the palace, we might get some spare change, but that's it. The only way you can actually play this is through physical gold. And the other thing I'd just like to say about this financialization, the end of the era of financialization, which is what we're seeing, it's going to take out the derivatives markets. Completely. That is bound to happen. You can make a case for the original purpose of a derivative, and that is, this was going way back. A farmer would, he would sell his product. He could see that, all wheat was coming on the market at the same time. So, when he was about to deliver his wheat, he would find that, the price was absolute rubbish because everybody else was delivering at the same time. How do you hedge against that? Well, the answer is that you can sell your wheat forward on a derivative exchange and to capture the prices which are more akin to where they are out of harvest. That was really the beginning of the Chicago Exchange. So I think that, that sort of sensible use of a derivative market, there is always a role for. But where they have become used by banks who've got no skin in the underlying game, just to punt it around and as a source of manipulating profits, that is going to die. And it'll probably die with our Western banking system. I don't know how they're going to. I can tell you how to rescue a central bank. That's very, very easy. But I can't tell you how to rescue the ECB because of its shareholders. You've got to rescue its shareholders as well. The scheme of arrangement goes not just one deep, but two deep. And you don't want to be having to do this at a time when the commercial banking network is also falling over. So this is really what we face. And I think that, I mean, saying the ruble is the elephant in the room, I think is a very good way of introducing the whole topic, because it is a very, very big and important subject. We are moving from a financialized world to a commodity-backed world. I think it's probably too much to say that currencies are going to be completely commodity-backed. I wouldn't say that at all. But what I would say is that commodities are going to be in there as a feature. And if there is any sign, I think that, let's say, the Chinese yuan or the ruble, starts being undermined by currency developments in the West, at that stage they will probably start introducing gold. So it's a fascinating situation, and this juncture, I think, is extremely important. I think it's extremely important to understand what is going on.
Yeah, I think, and this is so well, and that's so well put, because it's good to get the fuller picture and to understand what's going on. But I think what's so interesting at this point is how it's evolving. Obviously, we're gold buyers, stackers, traders, and we like to look at what's going on. And it was interesting. You talked about currency crosses there. And what was really interesting about that was that when Biden called the ruble rubble, what happened was, within a very few days, Russia came in and put that gold peg in. Okay, so it was but within 2 weeks of that, not only have they got the ruble price higher against the dollar, but they actually, at one point, it spiked to October 28th, October 2001, October the 28th, 2001 highs against the dollar. I mean, obviously it retraced, as you say, 78, 79. But what is so interesting is that when they achieved exactly what they wanted to do, using gold to really, we're not saying it's backing the ruble, but what it's doing is, of course, creating this link, and which is kind of the elephant in the room. And then all of a sudden, now we notice that we obviously we're connected with the liquidity providers, and we see constantly a $30 to $60 higher price on this now new bilateral negotiated price, obviously the 5,000 ruble program, that did its job. And now we notice that they're using this buffer here to keep the exchange rate within a micro managed range. And it's so interesting because we watch it like a hawk every day. We watch our liquidity providers telling us what the XAU ruble price is, not the XAU US dollar prices, and then obviously against the exchange rate. And it's constantly some 30 to 50, in fact, $30 to $60 higher. And that's dragging this paper-centric price. There's a terrible thing for the officials here. It's called an EFT, isn't it? An exchange for physical. And if you rig the COMEX price to a level that can then be transited into the spot market, which is, and I know you are one of the few people all over Basel III, NSFR standards, and technically this is a T+2 deliverable contract. So you transit that COMEX price into the spot market, which is now technically T+2 deliverable, you've just changed the game. And then when you add in the 30% discount that's being offered to friends for oil, and so now I can go out and buy, or not but if I'm well connected enough to go out and buy a 30% discount, I think Brent was 108 today at some point, $75. I can buy 26 barrels. What do? I can sell that into the global market. I know that's a flip of about $600 to $800 per ounce. Now, obviously, it's limited to the amount of that is put on offer at the PM fix. It's limited to that, and obviously it's not all put on offer because there is those constraints. So it's interesting because over time this is sucking that at the margin paper market liquidity out, and it's a one-way journey. And as it goes into Russia and China, obviously, as you said, they've got between their alliance, there's probably 34,000 tons of gold within that alliance. But they are that is the physical market now. It's not the LBMA anymore. So this is a mega shift.
There is another aspect to this which is fascinating, and that is the very fact that the unfriendlies, as Putin would call us, actually made all the paper currency reserves in the hands of the Russian central bank worthless, has actually sent a very strong signal to all other central banks. And I'm sure that at this moment they're having a series of meetings, internal meetings, saying, how does this affect the gold that we have stored in London, possibly New York as well. I don't think there are any other sort of major centres where they're stored. I mean, they would probably have them vaulted in Switzerland perhaps as well. But, those are the two things. Now, for a start, we turned round and told the Venezuelan government, no, they can't have their gold because the Americans told us to say you can't have your gold. Now, this is not, not a very good thing. So the trend, if you like, is confirming one thing. Don't leave your gold lying around in London. Get it back home. And I think that trend is going to continue. And there is another question, and I go all the way back to 2002, when Frank Venerosa stood up at a conference in Chile and said, after he'd done his research, that he didn't know how much gold there was out on lease, but he estimated it could be anything between 10 and 14,000 tons, bearing in mind that upper figure was roughly half the total gold at that time in central bank reserves. So, what's the position today? I think there has been a refinement in terms of, firstly, how the gold is used, and secondly, where it may be stored. So we saw this actually with GLD. Suddenly found that the Bank of England was a sub-custodian. Its gold it wasn't going to go anywhere, that was for sure. But where gold is out on lease or swap, there's the double counting effect. So it could be that the 35,000 tons, which officially is the total of all central bank gold, is probably 10,000 tons less than that. I would pluck a figure out of the air. Now, how do you resolve that one at the end of this period of financialization as currencies begin to collapse? I mean, it's the bit about the tide going out and who's wearing the shorts. It's that problem. Yeah. I mean, I can just see that we've got a load of issues coming up in the gold market, which I think could be extremely important. And one thing I always say to people, the point about gold is that you don't buy it to trade it. You buy to spend it. You'll end up spending it. Now, you can't spend, COMEX contracts. I mean, those you trade. Okay, trade. Take your life into your own hands, trade them. Great. But when it comes to physical gold, the reason you buy it is you want to have at least a portion of your wealth in something that is going to survive a currency Armageddon. Now, what we have with the current interest rate situation is the makings of a currency Armageddon. And we should look at what they're doing with rubles. We should look at what they're doing with yuan and a new currency in Central Asia and conclude that there are some people who've got a bloody good idea of what's going on who are opting out of the Western currency system. Why are they doing it? I mean, the answer, to my mind, is actually quite simple, and that is that all the malfeasance that's been going on about interest rates, What is inflation? I mean, they keep on saying that inflation is rising prices. No, it's not. It's a debasement of the currency. Why do they insist on leaving currency out of it? I mean, I remember seeing, I was obviously bored. I read one of the FOMC statements a couple of months ago, and there was no mention of money in it. Hold on. This is the Federal Open Market Committee, which basically deals with the money. They never mention money. I mean, what is going on here? And the answer is quite simple. They don't want us to understand that actually what they're doing is debasing the currency in order to pay the government's bills, in order to pay the politicians' ambitions for spending this, that, and the other thing. If we actually understood that, the whole system would fall apart tomorrow. That's why they insist on not telling us what inflation is. It's not a question of inflation; it's debauchment of the currency. And I think it was Keynes in one of his earlier books, quoting Stalin, saying, the quickest way to impoverish the middle classes is to debauch the currency. Come on, that's what's happening. That's what's happening.